Hey, good morning, folks, and welcome to week 7. I hope you are all having a wonderful day today. This is going to be our chapter 15 video lecture. We're going to talk about management information and accounting information. And so, just talking about how we make more effective decisions and a little bit more about the decision making process. And we'll go over financial statements just a little bit towards the end. The main thing we want to talk about is making decisions based on data and information as opposed to hunches and what your gut says. And so let's go ahead and get started. So, first of all, every decision we make, everything we do in business, ideally, what we want to look at is what is our risk, right? We always want to mitigate our risk or limit our risk, okay? And we found the best way to do that is to have better information, again, to make decisions based on data as opposed to making decisions based on how you feel. And so to improve the decision-making process, the information used by individuals and businesses must be relevant, okay? So it needs to be relevant, but it also needs to be timely. You can give me the best, most relevant information there is, but if it's old, then it's just not as good. It might as well be irrelevant. And so using relevant information results in better decisions, okay? So for businesses, better intelligence and knowledge that lead to better decisions are especially important because they can provide a competitive edge over your competitors and increase your profits, okay? Now, what you're going to be learning with Mike Lee is database management, a little bit about information systems and business intelligence. And there are positions out there for a lot of you info systems and finance majors that are specifically geared towards business intelligent roles. So providing relevant, timely information to managers to make better decisions, okay? So something to think about if that's a role you want to look at. Basically, the relationship between information and risk, pretty easy. The less information you have, the more risk. The more information you have, the less risk, okay? You know, I could use just really quickly, if we use COVID as an example, for the longest time, we have had little information on what this disease really does, what it can do, who it affects, how it affects the people it does. You know, what does asymptomatic look like, how it affects you long term if you contract the disease. And so we've been making a lot of decisions based on a huge lack of information. And so that's why it's been more risky as we move through COVID. And so it's just like, again, if I'm starting a business in stationery, and I don't look at what other stationery stores are doing, what other stationery companies are doing, how they've succeeded, how they fail, if it's the right time to be in that type of business, I'm probably going to affect my risk and more adversely. So I'll have more risk as I go into it if I just instead of just looking at what the numbers say, right? And so I think a lot of people have said, COVID, we've undertaken a lot more risk because we haven't looked at the numbers as much as we should have. We don't know enough about the disease to make an informed decision on a lot of things. And so right now, I think that's probably the best example we have. Here's a big one. Which I think a lot of you, when you do either your case study or the project, the group project, the difference between data and information. Data is the numerical or verbal descriptions that usually result from some sort of measurement, right? Data is the numbers. You can give me all the numbers that you want, and I still may not understand what you're trying to convey to me. Information is the data presented in a form that is useful for a specific purpose. Remember, I talked about graphs and charts, okay? You can show me a graph or a chart with the data in it, if presented effectively, then I'll understand it a lot better if, instead of you just give me the numbers. Okay. So what you as a finance person, or what you as a business intelligence person, or any business person, you take that data, you present it into a PowerPoint or a chart or a graph, and present that as information. In the case study with Chipotle, it's asking you, how does finance make decisions? And what happens most of the times, my students will just give me a bunch of financial information. I'm sorry, not even information, a bunch of financial data. They'll tell me the profits. They'll tell me, they'll tell me what the return on investment is for Chipotle. And that's just data. I want you to take that data and turn it into information. So what? What does it mean? Okay. Same thing with your groups. Don't just throw a bunch of data up there. Tell me what it means. Present it in a way that I can understand it. Okay. So data is the numbers. Information is how you present it. Okay. Presenting it effectively for purpose. Knowledge management. Really, Mike Lee is going to talk to you a lot about this. Okay. So a database is a single collection of data and information stored in one place that can be used by people throughout an organization to make decisions. This is, your servers. This is where you store your computer information. Or it could be potentially, a perfect example of this is the Google Drive. You all use Google. You all use Google Slides, or you Google Sheets, or you use, whatever the Google word is. I don't know. Anyway, but you use this Google and you store stuff in there. It's a cloud-based database. Okay, that's a perfect example of a good database. Okay, and then knowledge management, that's a firm's procedures for generating, using, and sharing this data. So for you all, again, for a good example, you take Google, you all are creating this Google Slides presentation that you're going to present to the rest of the class. This is how you're taking and generating the information, you sharing it with each other, and then potentially sharing it with us through Canvas. Okay, so knowledge management are the specific procedures, and Mike Lee is probably going to talk to you a little bit more about that as he is the expert. Okay, management information systems, again, MIS, this is where Mike Lee lives. It's a system that provides managers and employees with the information they need to perform their jobs. Okay, same thing again as Canvas or as Google Drive. Okay, the purpose of the MIS is to distribute timely is the key word here, timely and useful information. Information that is a week old or 2 weeks old, it's just not relevant anymore. Okay, so you need to use it for internal and external sources, right, to the managers and employees who need it. Okay, so a set of financial statements. There's a reason that the SEC requires publicly traded companies to put out their profit and loss statements at a certain time, because it's timely information geared towards informing the public, the shareholders, the stockholders. Okay. A firm's information requirements. So they are. Many firms are organized into 5 areas of management. This is something you absolutely need to know, because one day you're going to be working with one of these 5 areas. Financial. Okay, so that management area is going to be headed by your CFO, your Chief Financial Officer, and that's going to run all the way down through your AP clerks, right? That's accounting and finance. Your marketing, right? That's typically going to be your CMO, your Chief Marketing Officer. And those of you that work under that person, you're going to be working as, social media managers, social media listeners, SEO reps, sales reps, okay? Just general marketing folks, okay? Operations. This is your COO, your Chief Operating Officer typically. And so if a company's big enough, these are the roles that if it's company, this is your C-suite. If you're working under there, you're working in supply chain, you're working in logistics, you're working in agile, you're working in, doing Six Sigma, understanding processes, okay? HR, that's typically going to be your VP of HR, your VP of HR. And there, if you're working there, you're going to be working in recruiting. You're going to be working in HR generalist. You're going to be working under policies and procedures or legal. Administrative, this is your chief CAO, your chief administrative officer. This is kind of a catch-all of pretty much everything else. Here you could be working literally as an executive, or an executive assistant, or you could be working in some other form of administrative role. This is a lot. This is a bad slide because there's just a lot of stuff here, but I'm going to shorten it up. So managers in each of these areas need specific information. Financial managers must ensure that the firm's managers, employees, lenders, and suppliers, and stockholders, potential investors, government agencies have the information they need to measure the financial health of a firm. It's their responsibility to ensure that the profit and loss statements are accurate and timely, so people within the organization and outside of the organization can make financial decisions based on the firm's health. Operations managers are concerned with present and future sales levels, current inventory levels, work in process, finished goods, stuff related to manufacturing, okay, stuff related to purchasing, producing goods and services. Marketing managers need to have detailed information about the firm's products and services and those offered by their competitors. What are my competitors doing? So you need to go out and you need to do case studies on your competitors. HR managers must be aware of anything that pertains to a firm's employees. Again, we've often said HR is the most important of our 4 resources. Okay? And then administrative manager responsible for the overall management of the organization. Here's basically the 5 MIS functions. First, you collect data, you store data. There's companies out there. Bay Alarm is a perfect example of a company that helps store data. They basically house data or protect the data using fire suppression systems, theft alarm systems to store data for companies. Okay, so you collect the data, you store the data. A lot of companies now are using cloud systems to store their data, so it's much safer. You update the data, right? So if I have a company that I'm working with and I'm using a customer service rep data system, a CSR system, I'm talking to that customer, I'm updating it as I'm talking to that customer. That updates the data, which gets stored, which gets collected and stored, right? Okay. And then you process that data into information. At the end of the month, my boss, my sales manager, is going to ask, so give me all the information about all the customers you spoke with, or customers you met with, or the deals that you closed. And I'm probably going to create a presentation, a lot of charts and graphs to let them know what my sales numbers are like, what specific companies I'm working with. And so I'm going to take all the data that I've collected and stored, and then I'm going to turn it into information. For you all, for this project that you're working on as a team, you're collecting data from, for example, LinkedIn, or from Yahoo Finance, or from Google. You're then taking that stored data, right? It was just data that had been collected. It's stored. It's been updated. You're now taking that data from those sites or from the website, and now you're processing that data into information, okay, that you're then going to present to us. Again, Yahoo Finance is a perfect example. Yahoo Finance collects financial data on specific publicly traded companies. They take that data and they store it within Google Finance, within whatever data system they're using. Every second of the day, they're updating potentially the stock price for that whatever company that is. Okay, or whenever the financials come out, they're updating it to show us what the new financials are, what the new balance sheet looks like. Okay, and then you take and you extract that data from Google or from Yahoo Finance, and you process that data into a chart or a graph that I can see. What's Apple's profit look like over the last 2 quarters? You're presenting that in a graph to me, and then you're going to take and turn it into a PowerPoint presentation. That's what MIS is for. That's what people do with information, right? So remember this, five functions. Yeah, why is accounting information so important? First and foremost, accounting is the language of all business. Okay? It is so important for you to understand the accounting process, and it's so important for you to understand how to read profit and loss statements, okay? Which we'll go over in a second. That's why we have you go through Accounting 201 and 202. Even a basic understanding helps. Some of you, based on your Accounting 201 class or 2001 class, you may decide you want to switch to accounting. I've had a lot of students do that. It's an incredibly viable position. It's a lot of times recession proof. It's a great role in terms of just the impact that you can make on business. Often I'll have people ask me, what's more important, the doctor who saves the life or the CFO of the hospital who keeps the hospital in business? For me, I think they're both equal, right? Without that CFO making the right decisions, that doctor has no place to do his or her work. And so they can't save lives, okay? And so accounting is an important position in business, so understand that, okay? So accounting is the process of systematically collecting, analyzing, and reporting financial information. That's it, right? Not only can accounting information be used to answer questions about what was happened in the past, it can also be used to help make decisions in the future. We're going to talk about you're going to talk about at one point in finance when you take a managerial or Accounting 202 ratio analysis. You look at the balance sheet, you look at the income statement, and you create ratios based on the numbers within those statements, and then you can take and make decisions based on those. My favorite ratio is called the debt to equity ratio, and it basically looks at how much money a company has borrowed, or how leveraged are they, debt to equity, remember this, how much a company has borrowed from a bank or lenders, whoever, as opposed to how much of their own money have they put into the company. If you have a company that has a high debt to equity ratio, in other words, they have borrowed more money than they have put in themselves, that's probably not a company I'm going to invest in. Okay? It's called being over leveraged. Okay? And it's important to know that, because if a company's borrowed too much money, how are they going to pay it back? Okay? They have to do certain things to pay it back. And so if you just look, and you can get all that information right off the balance sheet. And so if you look at a debt to equity ratio, you can just based on that one ratio, you could say, maybe that's not a company I want to invest in because they're over leveraged. They've borrowed too much money. Okay? So, to improve the accuracy of a firm's accounting information and its financial statements, businesses rely on audits conducted by accountants employed by public accounting firms. The first job of most of, at least our accountants coming out of Point Loma, they go to work for public accounting firms. Some of them in the Big Four, such as KPMG or Deloitte & Touche or Ernst & Young. Some of them working for smaller firms like a Lindsey Brownell, or a mid-sized firm like a BDO Seidman or a Moss Adams. They are actively seeking out our accounting students. And so that's typically why most of our accounting students, their senior year, they've already got a contract job, already a job with a signed contract to start work as soon as they graduate. So for an entire year, their final year of school, they already have a job guaranteed when they walk out the door. That's how important accounting is in business. That's how sought after good accountants are. Now, not everybody's cut out to be an accountant, but you won't find that out until you take Accounting 201. Why audit financial statements are important? Audited financial statement. Basically, an audit is an examination of a company's financial statements and the accounting practices that produce them. The purposes of an audit is to make sure that a firm's financial statements have been prepared in accordance with GAAP, generally accepted accounting principles. That's what governs U.S. financial statements. Okay? Any company in the U.S. doing business must meet GAAP. Okay? Let's see, what's the next one? Okay, so I'm going to go back. Enron. Right now we have a process put into law. It's called Sarbanes-Oxley, or SOX, and it basically states that you have to have an audit firm. If you're a publicly traded company, you have to have an audit firm like a KPMG or Deloitte or an EY come in and accurately audit your financial statements to make sure they are accurate. So what happened was Enron, there was a big company, and they were losing money, and they falsified their financial statements severely. This is a Fortune 500 global international company doing business here in the United States, and they falsified their financial statements to make it look like they were making more money than they actually were. Their audit firm was one of the largest firm at the time. It was called Arthur Andersen, and Arthur Andersen colluded with Enron to falsify the audit records and to show that they made more money. The result was Arthur Andersen, the largest public auditing firm, public accounting firm in the world, went bankrupt and went out of business. Enron went bankrupt. They basically fired. I think only one person went to jail. All the people, when they say that the stock market is only for the rich, all the people who lost most of the people that lost the most amount of money with Enron were the employees. All the stock purchase programs, all the profit sharing programs, all the stock that the employees held, the smallest employees to the largest employees, they lost all of their pensions. They lost all of their retirements. Okay? And people died. People committed suicide as a result. Right? People lost everything. Okay? And so they came in, Congress created the Sarbanes-Oxley Act, and now we have these processes put in place because we can't allow that to happen again. There were other ones, Enron, WorldCom, Peregrine Systems. All those big companies kind of did the same thing. They falsified their accounting records to show a greater profit, and in the end, went bankrupt. And people lost their lives, people lost their livelihoods, people lost their pensions. It did irreparable damage to the market. Okay? So this is why accounting, accurate, honest, ethical accounting practices are so important. Okay? If you want to make a difference, this is a potential way to make a difference. You don't have to go out and preach, or you don't have to go sit at a pulpit, or you don't have to do work with in the Congo or work down in Central America. You can be an accountant and you can make a difference. Okay, different types of accounting. Accounting is usually broken down into two broad categories. Managerial accounting, that is the finance people. Those are the people that take the accounting records and help make decisions. And then financial accountants. Financial accountants are the auditors or the staff accountants, the people that actually put the information together so the managerial accountants can actually make decisions and create information instead of data to make the decisions. So financial people are the accountants, what we call an accountant. Those are typically people with degrees in accounting. The managerial accountants, those are the finance people. Those are typically people with degrees in finance. MBAs are managerial accounting. Financial accountants typically are CPAs. Okay? Additional areas of accounting include cost accounting. That's more in manufacturing and home building. Tax accountants, those are the people that do your taxes or do corporate taxes. Government accounting, those could be people who work for the DCAA, that's the Defense Contract Audit Administration. They go out there and they make sure that we aren't spending, $500 for a hammer for the government. And then nonprofit accounting. Those are people who do accounting for, obviously, nonprofit firms. Careers in accounting. Accountants generally are classified as either public accountants. Those are the people that go to work right after college into KPMG, Ernst & Young, Moss Adams, and private accountants. Those are the people that work for Qualcomm or Illumina or Nike. and they're working specifically for a corporation to do their accounting for them. Okay. CPA is an individual who has met state requirements and experience and has passed a rigorous accounting examination. This is not easy. It is one of the most difficult five-part tests that you could possibly take. But once you pass it, you're a CPA. Okay. And so it's a highly profitable for you as an individual to be particularly a California CPA. Okay. I guarantee you, if you look up the controller at Nike or the CFO at Nike, probably not the CFO, that's probably an MBA, but if you look up the corporate controller at Qualcomm, the corporate controller at Nike, any big, sexy company you want to work at, guarantee they all have CPA. They all started at a Big Four accounting firm. And they're making pretty good money. Sean Duffy, this is an example I always use because I know her well. Sean Duffy is now the CFO of Viasat, which is a mid-size publicly traded company here in San Diego. Pretty good sized company. She spent, I want to say, 7 or 8 years at Ernst & Young, left there as a senior manager, public accounting CPA. I recruited her out of there and helped place her as the corporate controller at Viasat. And now she has been there probably 12 years. She's now the CFO. Her salary is in the range of, $400,000 or $500,000 a year. Maybe, probably more. Actually, probably with stock and everything like that. It's public, so you can look at it. She's probably making close to, $3, $4, $5 million a year. And she started out as an accountant. And money shouldn't be everything. Okay, it shouldn't be everything. Okay, here's a couple of accounting equations you should know. The accounting equation is the basis for accounting process. Assets equal liabilities plus owner's equities. If I take all my liabilities, which is basically my debt, and this is the balance sheet, and I add that to my equity, the money that I've put into it myself, or the stock that I've sold, that should equal all my assets, right? Because with my liabilities, I buy a house, okay, just as an individual. My liability is my mortgage, okay? So that mortgage now all of a sudden is a liability, but I have a house, which is an asset, right? And then my equity could be like my money I've put into the house. Before, I only borrowed a certain amount of money. So my house is, my house I paid $300,000 for. I put 20% down, okay? So I bought the house. The house is the asset. The liability is the remaining $200,000 that I'm borrowing, and then the equity I've put in is the $100,000. That's the equity plus the equity that I have on top. Okay, so all those have to equal one another. Okay, assets are resources a business owns: trucks, buildings, patents, computers. Liabilities are a firm's debts, and then owner's equity is what will be left over if the owner's debts were sold. So if I sell my house, whatever I get out of it, that's my equity. The balance sheet. The balance sheet or statement of financial position is a summary of the dollar amounts of a firm's assets, liabilities, and owner's equity. Accounts at the end of the specific accounting period, right? So accounts at the end of a specific accounting period. You have to know that. It's got to be a specific accounting period. The balance sheet must demonstrate that assets are equal to liabilities plus owner's equity. Again, it's a balance sheet, okay? And I'm going to show you one right now. Here's what it looks like. Here are the assets. The assets are cash, savings, an automobile that they purchased, a stereo, a television, or furniture. This is on individuals. So their assets are worth $26,500. Their liabilities are the automobile loan and credit card balance. Okay? That's their liabilities is $10,000. And then the net worth is $16,500. This is what, right? So now we have 26.5, 26.5. They balance. It's a balance sheet. Here's what a company's balance sheet looks like. current assets, fixed assets, intangible assets, right? So all the assets equal $340,000. All the liabilities, long-term, current, long-term, and then the stockholders' equity, all this equals 340. So when I was talking about a debt to equity ratio, what I would do is I would take all of my liabilities, right? This is my debt, $110,000. And then what's my equity? I would take that and I would divide 110 by 230. And if you look at this, I've got more equity in this company than I do debt, about 2 to 1. Okay. So this is a really good debt to equity ratio. I would probably invest in this company. But what if I had $230,000 in liability as opposed to $110,000 in equity? That would look a lot different. How am I going to pay off all that debt? 2 to 1 debt. Okay. These are the things that you can pull from these sheets, from this balance sheet. You can get a lot of information. If I saw this flipped, like now, I would invest in this company because again, the debt to equity ratio is low. But if this was switched, okay, if this was here and this was here, I wouldn't invest in this company because their debt is much higher, double the amount of their equity. Okay, we can talk a little bit about this on Wednesday. Okay, assets on the balance sheet. Assets are listed in order from the most liquid to the least liquid. Liquidity is basically how easy can I sell these? How can I get them to cash? Okay. Current assets. Assets that can be converted quickly into cash or that will be used within 1 year. Current liabilities. Debts that will be repaid in 1 year or less includes AP, notes payable, salaries payable, taxes payable. Liabilities, long-term liabilities, debts that need to be repaid for at least 1 year. And then owners or stockholders' equity. For sole proprietorships or partnerships, the owner's equity is shown in the difference between assets and liabilities. For a corporation, it's in stockholders' equity. And then retained earnings, the portion of a business's profits not distributed to stockholders. Know that. We don't distribute that in the form of dividends. We keep it, reinvest it. The income statement basically is a summary of a firm's revenues and expenses during a specific accounting period. The difference between income and expenses is referred to as profit or loss, cash surplus or cash deficit. For a business, it's revenues, so sales, revenues, minus COGS, cost of goods sold, what it cost me to sell, what it cost me to make the revenues, how much did it cost me to make my revenues, my operating expenses, that equals net income. Here's what it looks like for an individual. I have my income, which is $1,900 a month take home. Here's all my expenses. My monthly expenses minus this, that's my cash surplus. You're going to create one of these when we do Excel. Steve Cosentino is going to have you do your own income statement or your own budget. Here's what it looks like for a company. You have revenues of $465,000, less sales discounts. Here's your revenues. Okay, here's what it cost me to make those revenues. Here are my operating expenses. Subtract all this, less, right, net income before taxes, and then net income after taxes is this. That's an income statement. Just remember, revenues minus cost of goods sold minus operating expenses equals net income. Here it is. Revenues is the dollar amount earned by a firm. Gross sales minus sales deductions equals net sales. Okay, gross sales, the total dollar amount of goods and services sold during the accounting period. Deductions, returns. When you buy something and you return it, they have to take a loss on that. Sales allowances, and then sales discounts, right? When I intend to sell something for $30, but I give you 10% off, okay? 210 net 30. This is basically accounts receivable credits. So 210 means if I pay you within 10 days, you'll give me a 2% discount on the purchase. But no matter what, I owe you all the money within 30 days. So 210 net 30 means 2% discount if paid in full within 10 days. If not, I owe you everything within 30 days anyway. Net income occurs when revenues exceed expenses. Net loss occurs when expenses exceed revenues. And then finally, the statement of cash flows. This is a statement that illustrates how the company's operating and investing and in financing activities affect cash. So this is probably one of the most important financial statements, because cash is king, queen, whatever you want to call it. Cash is super important. Companies need cash to operate. Okay, you have to be liquid. And here's what a statement of cash flows look like. This is what. So we have net income. Again, here it is. We took this off the income statement, brought it here. Adjustment to reconcile, we have depreciation, we have decrease in accounts receivable, increase in inventory because we bought stuff. We have to deduct money because we bought stuff. Increased in AP, and then increase in income tax. So our net cash provided by operating activities is this, right? We purchased equipment, purchased investments, sale of investments. There's that, the difference between those two. And then you look at this and you get down basically to all the way till it's cash at the end of the year. This is what we have. We then transfer this to our balance sheet. Okay. You're going to learn a lot in 2001, 2002. Financial ratios. So here's a couple of really good ones. That's what we talked about, a number that shows the relationship between two elements of a firm's financial statements. So return on sales, that's the profit margin. Okay, this is a financial ratio calculated by dividing net income after taxes. So you take net income after taxes and you divide it by net sales, and you get a return, right? You get a return on sales of 6.7%. Okay. The return on sales indicates how effectively the firm is transforming sales into profits. Do we have too many expenses? Like we could have $10 million in sales, but what if we have, $9 million in expenses? What are we doing? Right? We have to look at that number. We don't want to sell more. We want to decrease our expenses. So how do we decrease our expenses while maintaining that revenue? Okay. So it just looks basically how effective a company is in driving sales. Okay. A current ratio, basically a financial ratio computed by dividing current assets by current liabilities. Current assets divided by current liabilities. A high current ratio basically indicates that a firm can pay its current liabilities. Okay. So that means I have current assets. I have enough assets that I can go liquid. I can get cash for to pay my liabilities if needed. So I've got $182,000 in current assets, which I can translate into cash quickly if I needed to pay back an instant liability, a current liability. So that could be a bank loan, that could be a payroll, that could be accounts payable. I could turn this into cash to pay this off. We want this number high. And that's it. I told you a little bit also about the debt to equity ratio, which is important. There's some other ratios that are important. The inventory turnover ratio. How are we selling, right? Are we storing too many products that we sell? Are we not storing enough products? Okay, here's one, right? Let's see, boom, 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 right? The inventory turnover ratio measures how effectively a company manages its inventory. And then the debt to equity ratio measures financing versus equity to obtain its assets. A good debt to equity ratio is about 1 to 1.5. Okay. That's it. If any of you have any questions on accounting, if any of you have any questions on potential careers in accounting, what that could look like, we can definitely have a conversation about that. Again, I've seen accountants. You don't have to just, understand accounting is important. Even if you got your degree in accounting, you wouldn't have to go into accounting. I've seen a lot of accounting majors go into sales or finance or investing or real estate. Understanding accounting and the accounting process and these ratios will help you make better decisions. That's it. And again, accounting is the language of business, so it's important to know that. I hope this makes sense to you. Again, any questions, just let me know. If you have any questions, write them down and we'll cover them on Wednesday if you want. But in the meantime, have a great rest of your weekend. Again, welcome to week 7, and I look forward to seeing you all sometime this week. Thanks. Bye.